Everyone tells you to run toward safety when things get scary. That's the advice. Buy the safest assets. Hide in the financial equivalent of a bunker. But here's the uncomfortable truth. Sometimes the safest place is where the fire starts. In March 2020, global markets didn't panic because of risky bets. They panicked because everyone rushed into assets that were supposed to be safe. U.S. Treasuries, cash-like funds, the things that never break. And suddenly, they did. Not on paper, but in real life. This matters right now because the world is more leveraged, more crowded, and more synchronized than ever. When everyone believes the same thing is safe, safety becomes fragile. Let's walk through how that happens. A safe asset is supposed to do three things: hold its value, be easy to sell, and work when everything else fails. Government bonds, money market funds, highly rated debt, they're the financial shock absorbers of the system, until too many people lean on them at the same time. Imagine a crowded theater. Someone smells smoke. Everyone calmly stands up and walks toward the same exit. That exit worked perfectly when only a few people needed it. But now it's the bottleneck.
In finance, that bottleneck is liquidity, the ability to sell something immediately without changing its price. Safe assets depend on liquidity more than risky ones. That sounds backward, but it's the key. Risky assets are expected to swing. Safe assets are expected to move smoothly. So when they don't, panic spreads faster. Here's the quiet mechanism most people miss. Safe assets are often used as collateral. They're pledged again and again to back loans, trades, and leverage. One bond supports many promises. As long as prices are stable, the system hums along. But when everyone wants their safety back at once, those promises collide. The math gets uncomfortable fast. If 10 institutions all rely on the same safe asset to settle obligations, and one pulls out, the others scramble, not because the asset is bad, but because it's suddenly scarce. Prices gap, trades freeze, and the safest asset becomes the most dangerous thing to hold. This is where hype and reality split. The hype says safety means no risk. The reality says safety means hidden dependence. Treasuries didn't fail in 2020, but the market around them did. Buyers vanished. Sellers flooded in. The safest market on earth needed emergency intervention to function. That's the irony. Safety required rescue. And this isn't a one-off. It's structural. Every regulation that pushes institutions toward the same safe assets increases crowding. Every risk model that assumes perfect liquidity reinforces it. Every investor who believes they can exit instantly adds to the illusion until the exit shrinks. Zoom out, and the implication is unsettling. Modern finance doesn't break where risk is obvious. It breaks where confidence is highest. The more an asset is trusted, the more invisible leverage builds around it. The more invisible leverage builds, the more violent the unwind. This is why crises feel sudden. The danger wasn't hidden, it was normalized. So the next time markets shake and you hear the familiar advice, move into safe assets, it's worth asking a harder question. Safe for whom? And safe under what conditions? Because in a system built on shared beliefs, safety isn't just about what you own. It's about how many other people think they own the same escape hatch. And when that belief changes, the most dangerous moment isn't panic. It's the second everyone tries to be safe at once.